watching Famous Dave on YouTube.
All right, welcome back to the Short File Show Live. My name is David Lincoln, and I'm joining you from Cape Cod, Massachusetts, home of the Pilgrims, with a special guest, Ishaan Start from Eagle Investors today. Welcome to the program, Ishaan.
Thank you, David. Thank you so much for having me today. I appreciate you bringing me on. Thanks.
Cool. So you are you're from Indiana, is that correct?
Yeah, so I'm originally born and raised in Ohio, specifically close to Cincinnati, Dayton area, and then I currently live in Bloomington, Indiana. But I'm actually in Ohio right now due to this virus, so quarantining over here back in Ohio. And yeah, Dave, thanks again for having me, and I'm excited to speak with you today about the market, the VIX, actually really whatever you want. And I'm sure we have a lot of people here on the live stream, and they can feel free to ask questions, but I'll let you take it, Dave.
Cool. Well, I mean, you and I just met each other a couple weeks ago through Oliver Rios, and I came on and spoke to some of your folks on your website. I was very impressed, actually. Ishaan has a business through the website and hosts. You host a live stream almost every day, so you're an old hand at this. This is nothing new to you, right?
Yeah, so what we do is we host a variety of different stuff, but our main focus at Eagle Investors is education and knowledge sharing. So what we do is we do a lot of educational webinars. I know, Dave, we brought you on for our introduction of volatility and VIX, which you did a fantastic job. But we try to diversify with the different webinars. But we actually just started a options day trading live stream, which we run about 2 to 3 days a week. And we have one of our he's a professional trader. His name is Julian. And what he does, he screen shares, him making profits for equity and option day trading. But yeah, I'm on there and we're taking questions all day. But it can differ. And again, thanks, Dave.
Well, you get to relax. You get to relax. You don't have to be in the hot seat and trying to help out all these people. At this moment, you actually get to be the person that we can talk about for a change. So you're out of the host's duties for a second here. Yeah, I was impressed, actually. When you take people and they spend money to be in, they want to learn about trading. They've proven that by spending some money to be in a chat, and they're taking this stuff seriously. I'm impressed by that, and I felt the energy of people watching that stuff, because these people are not just they're not just like drive-by people. They're serious about learning about trading, and that was exciting to me to be in that environment. It kind of reminded me of like when I first started out in 1994, and I started as a runner on the floor, which is sort of an old school way of doing things that doesn't really happen anymore. What was your start as far as trading? Were you into trading in like high school and before, or how?
Yeah, that's a great question. Yeah, Dave, that's a great question. I think I've been asked this maybe a handful of times before, but pretty much. So I got into trading and investing. It wasn't trading; it was investing first, and that started very early. So I was privileged enough to have my grandfather. He was very talented and savvy. He was actually a general surgeon. So the vast majority of my family are doctors, and I'm actually the one who kind of broke away from the pack here to do business. But kind of one of the things that started me with that is my grandfather. He was a general surgeon in Maryland. So his day job is going to take people's gallbladders out and fix people, and then at night when he came home, he'd watch CNBC and be on the phone with hhis broker investing in things like Microsoft at $1 a share back in the day. So I was really lucky to be able to have somebody who was an old timer and really old school calling in, and he was able to mentor me and also some securities to me. Once that happened, I was able to manage my own money. And again, being the business guy with the family of doctors, their job was to make the money, and my job was to make their money into more money. So over time, pretty much, I got thrown into that, and that was my job, is to prove myself apart from all these doctors. So that put into a lot of time into the markets, a lot of effort. But then really take a different spin onto it. So there's one thing, making money on my own accounts, and that brings us happiness, and that's good. And at this point, we're used to creating income. But then there's another thing, spreading the knowledge and showing other people how to be a consistent, independent, and successful trader and investor. And that's what really brings you the joy and the happiness. I'm sure, David, you kind of feel a little bit about this, is that you get to the point where, it's great to make money on your own account, but it makes you even happier to see other people making money on their account. And there's one thing, there's winning trades, but there's also a process and a strategy. And it's a pleasure when you find those people who are willing to invest in themselves and their time and their education. And what they're able to do is they're able to turn into, consistent traders at the end of the day. So that's how I got my, my start, Dave, is I always had a really big focus on education and doing things beyond just for yourself. And I know in trading and investing, we can get a little caught up with, oh, I made money off the VIX and you didn't, or I made money off this trade and, I told you so, and all that kind of stuff. We try to put that aside and we say, we don't care whatever your knowledge is, and no question is dumb, and we'll help you from the bottom up. We offer a full education course that we put together in different kind of softwares to help somebody from, your beginner all the way to your expert level become, dominate the market. So thanks, Dave.
Now, did my family? There was pressure. Like my dad really didn't think that trading was like a real job. Like working on Wall Street was not a real job, and he would have much preferred I be a doctor or have like a real professional background. Was there pressure like that in your family as well?
Yeah. So that's a great question, Dave. And I mean, like some people say this, so like, how are stocks even real? Compared to you go to the hospital and you have to help somebody physically, but on trading these days, you're looking at a screen. So I do get those questions sometimes, but at the end of the day, it's more. It was more of, hey, prove yourself, is because the definition of success in my family was stay in school for 14 years after high school and get your doctor and get your PhD and, eventually start earning when you're 35. It was, hey, I didn't need necessarily that doctor degree, but I need to be able to start earning, at a smaller age and show that, hey, I was able to say, oh, I'm going to go do my own thing and not, follow the status quo. But be successful in a sooner time period than, say, the other doctors. So kind of the goal is to be and maintain to be just as successful or even more successful as the doctors by the time they're, earning at 30, 35 area. But that was kind of the base, and then after that happened, it was more like, hey, let's help you guys. Let's teach you guys a little bit more about finances and let's get you guys in tune with it just as much as, me. So that's a great question, Dave. Yeah, thank you.
So do you maintain your own trading positions now, or are you focused most on your business, or do you actually have your own like trading on the side that you do?
Yeah, so that's a great question. So one thing is, so at Eagle Investors, what we do is we're a team of professional investors and traders who issue trading alerts, which is a feed of what we're doing with our real money in real time. Obviously, we're not trading for people, but we're offering alerts as a tool to show where our professionals are putting our real money. Through our time in the markets, I would say that I would classify myself as a professional. I know you would as well, Dave. And what we got to do is we have to set the tone. So what I find myself is I don't necessarily need to be putting out alerts every single day because we have a bunch of talented traders and investors who are able to do that. But I see myself being able to be the example and showing that, the chief executive officer of the company is going to be doing the same work as, your moderator or your, professional trader in the company, and you have to get on that level there and that down to earth level and, also have your own clients. So, I do trade and I trade mostly earnings. So I'm somebody who takes a little bit more of a approach where it's a strategy where I don't have to stare at the market all day and look at the ticks. I'm not day trading. What I'm doing is I'm doing like overnight swing trades on earnings with more defined risk and more of a plan. Like I enter at 3:00 p.m. before earnings and I exit 10 p.m. to 12 p.m. the day after, But that's kind of the way that I trade, is a little bit more relaxed and a little bit more defined. But at the same time, I do have to worry about, and my main thing is educating people and helping people understand what I'm even doing, entering that alert and stuff like that. So, but yeah, Dave, that's what I would say is I do a little bit of both, and I think you have to do a little bit of both.
Now, do you, as you've talked about, I focus a lot on the VIX, and we had this big sort of Volmageddon thing, which was in February of 2018. And I found out, much to my like shock, right after that several followers of the channel had were looking at some of the strategies we were talking about and had kind of gone sort of all in on some VIX strategies. And ever since then, I've made it very clear that a lot of the strategies which I'm talking about are not necessarily what you want to be doing with your accumulating wealth over time. Do you make a distinction for people between like your quote unquote retirement money versus your like trading money? Because I found that ever since then, I like to make the point that, and it's, some traders do this and some don't, but I like to make the point that for me personally, I have a certain section of my savings that's kind of in a safer, more conservative spot, and then I have my sort of separate, more play money for trading and whatnot. Do you operate in a similar way? I mean, I know I come from like, my parents are from that buy and hold investor thing through many generations in my family. And I know a lot of traders have kind of gotten away from that, but I still have a separate section of money that's like my retirement, quote unquote, money that's in conservative spots and is separated from the money I use for trading and everything about my YouTube channel. Is that something like that for you as well?
100%. So Dave, we get people in every day. We're pulling people in from all across the world who are don't know much, and they're looking to get a base knowledge. What we'll see is what we saw in the past. This is the problem that I'm sure everybody kind of has, and that's a problem we're trying to fix, is that people will come in with their Robinhood account, right, which makes it seem a little bit like a video game, a little bit too much like a video game, right? And they get in with their Robinhood account, and they see an alert for like a Tesla put, right, and it says very high risk, like exposure is 2% of the account, but they say, hey, that these people are pretty good, let me give it a shot, and they dump in 75% of their entire trading account, which just so happened to be 75% of their life savings into the Tesla put, and maybe it was the volatility plays as well. So, what can happen is you can win big. You can be trying to go for that 1, 2, 3 parlay, like in the sports betting, where you hit the Tesla put, then you hit the Tesla call, and then you hit the Tesla put for, big money. But chances are you're going to lose all your money doing that, So what we do is we teach consistency, and really how it goes is so. The number one thing you have to do is you come in and you say, what's your risk tolerance? And I think risk tolerance has to do a lot with age. Usually the younger you are is the more risk in terms of like capital you're able to be able to use, and the older you are, kind of the less, because the older you are, the closer you are to retirement. So the less volatile you want your accounts to be, because if you're 45 and when you're 65, it's very volatile. You might not have enough cash to retire, Whereas when you're 25 and retirement's 40 years away, you might be able to go down a little bit in 20 years. But in the grand scheme of things, you'll be up over time, But the main thing I say is that you really need to take a look at. We don't want to be trading with money we can't afford to lose. And so what I say is, if you're going to go play poker with your buddies on Sunday night, that's the money that you're going to be putting into options, is the money that you're going to be taking into poker on Sunday night there. So it's not the grocery money, it's not the kids' money, it's not the toothbrush money and the food. It's the poker money. It's the money you're going to go to the casino with, and that's what we need to be trading options with. Second of all is being able to figure out what's that percentage and that weighting. What's the process? So you have. What I say is I can't make any recommendations, but I can tell you what I'm doing. And what I'm doing is, I have 80 to 85% of all of my liquidity, all of my cash, right? That's invested, and that's different. Maybe 10 to 15% is my risk tolerance in an options trading portfolio, where I can be a little bit more active in it. Maybe with the other 85%, take us as a pie chart here. We have 15%, which is our options trading. Other 85% here, maybe 50% is in stocks, maybe 20% is in bonds, and 10% is in gold. I'm not sure what it would be, but the more you have in a trading account, the more volatile your life is. And I would say the more volatile your life is, the more stressful your life is. So I'd say there's a direct correlation there between exposure to a trading account and stress of your life, based on your overall net worth, if that makes sense. But what we teach is, we have a process here saying, how do we break it down? What's the percentages here? I have Ishaan, I have my net worth right here, and how should I split that in percentage wise to be consistent and successful overall, investing and trading. I mean, we can go more in detail in the percentages and how to split that up and stuff, but the general thing is we shouldn't be trading with money we can't afford to lose, because if we put our money in an options position, what we're assuming is that we donated that money. That money is gone. That's what we assume when we put it into a position. Hey, if we make money off of it, that's wonderful. Hey, that's lucky, and we made money, but we assume that we donated money to a nice cause if we put it into an options account. So, yeah, Dave, that's what I would say.
Yeah, I get it with new people too, and it's almost like human nature. I mean, when you come and you start studying, and somebody says, "Don't take more than 1% in any one trade," when you see something that works for you, you kind of want to put more of that in. So I get it. So you almost have to kind of go against human nature to discipline yourself to be an effective a trader, because when you feel that rush of making money on something, and you're like, well, I only put $200 in, and wow, I doubled my money if I'd only put more. And so I get it why people do that. What would you say to somebody, because I know there's people out there, when we start talking about, okay, well, I'm going to put this retirement money here and this in gold and blah, blah, blah. What do you say to people out there that maybe they don't have any money right now? Like maybe they're just out of college, or they haven't gone to college. There's people that maybe they're working at, a Wendy's or McDonald's or something, that came online. They want to learn. They want to lift themselves up. They want to learn about this stuff, and they're saving money slowly. Maybe they've got $1,000 saved. What's the path for somebody like that to financial success? What would you recommend to somebody that maybe is like working an hourly job, doesn't have any money saved? Where should they go from there?
Yeah, so that's a great question. That's a lot of people are like that. That's like your average guy, comes in and he says, I don't have that much, and I'm looking to get started on a small account, and I don't know anything. Can you help me make money? What I tell people, and what I would say is, number one, you got to save money, and it's really not worth gambling if you're living paycheck to paycheck, which a lot of people are, and there's nothing bad about that. If you lose on your options trade, it's going to cause significant stress in your life, and that's stress that you don't need right now, and that's stress that could be used on saving more money, that could be multiplied into more money, 5 years down the road. So what you got to really do is you got to consider, and what I tell people is, number one, you got to save. But what you can do is, I'm not saying that you can't to forget trading and to forget investing in options trading. Save your money. That means don't dump it into a brokerage account right now. What you want to do is you want to save your cash, and then second of all, you want to open a paper money account. So like Thinkorswim, paper money. And what you can do is, during that time, what you need to do is you need to educate and you need to practice. So, for example, Warren Buffett says the best investment you can make is an investment into yourself. And so what we would say is, spending a little bit money on not necessarily like a setup and a new computer, but an education and somebody to really teach you and mentor you, who's gone through blowing a few accounts in the market and not having a guide, but sticking it through 30 years, and going through the brutalities of recessions and, all of that, and have them simplify it for you and tell you that, and say that for a little bit of money, or a little bit of your time necessarily, you can find stuff online and you can get a whole education on YouTube, but if you invest in your time and you practice during that time of you're saving your actual money, by the time that you have $5,000, $10,000, that's kind of throwaway money there that you've saved up in your Acorns or Robinhood account or something, you have the education and resources and technology for you to succeed. Because the last thing you want to do is spend 5 years saving up, but during that time you didn't educate yourself and give yourself the opportunities. And then when you get that $5,000, it's gone really quick, because options trading is it's very cutthroat. I would say it's one of the more cutthroat business industries you can go into. Trading in general is, if Dave, if you lost money buying a UVXY put, the seller made that money. So if it's not your money, it's somebody else's money. So the sharks will find a way to win. And the reality of the situation is that the problem is that a lot more people are losing money in options than making money right now. So we found that problem at Eagle Investors, and we're working to shift the odds in the retail investors' favor. And what we would say is you got to educate, you got to practice, and you got to find those people who are going to help you dominate the market before throwing money in yourself and losing to the sharks, if that makes sense. But yeah.
Yeah, that's some great advice. And I think sometimes we get so far ahead of ourselves because we're like, okay, well, this is what you should do, and you should allocate this and that and the other thing. But, the message is for a lot of people, the best investment you can make, and people don't want to hear this at all, but the best investment you can make is to pay down that credit card. If you're paying 28% on a credit card debt, which granted, people that are listening to this now are, someone who's listening to this has credit card debts. I guarantee it. You can make synthetically, 25% on your investment if you, instead of jumping into one of these brokerages accounts and having fun in the market, if you just bite the bullet, pay off those credit cards and get that debt off your sheets. And like I said, people don't want to hear that, but that, getting your financial house in order before you start playing these games is super, super important, and getting that discipline down. And like you alluded to, you need to have a decent enough job that you have a little bit of extra income to start feeding into this stuff. Because if you've got a little extra money coming in, then when your account goes down a little bit, if money's coming in every couple weeks or something, it cushions your situation a little bit. And I think a lot of times we just kind of assume that people have like a good job and this income coming in that they can use for trading, whereas so many people just need to focus on learn how to save money, learn how to live below your means. Make this a priority. Make your future enough of a priority that you're willing to allocate a certain amount of money first to saving up, to building up a little bit of a nut, so to speak, and then maybe investing in your education as far as, a service like yours or some of the other ones that are out there to educate yourself. I just saw something on Twitter today where it said like, the average doctor, 10 years studying, the average lawyer, 10 years studying, the average trader jumps in right away. Don't be that guy. And there's nothing to be ashamed about getting your financial house in order before you jump into this stuff. And I think it's something that, like I said, it's automatically you're making a good percent if you pay down those credit cards and get yourself out of debt before you jump into this stuff. It can't be emphasized enough, I think.
Yeah, and Dave, I would say that that's the problem with current education, options education, and trading education. Is you go on YouTube and you see these ads with guys in front of fancy cars and private jets saying, you can be like me by following my winning trades. Little do they tell you that you got to educate, and that there's a whole process behind it. It isn't as simple as just, hey, clicking a button and following a winning trade with some some self-claimed guru or something like that. And that's the problem, is that that's kind of the I wouldn't say it's the media, but it's like the front that's come on, is that day trading and options is how you make money quick, and how young guys are like, it's almost like Bitcoin millionaire. It's like options trading and day trading that's the new thing. And being younger, I see this. I see that a lot of young people losing their money, thinking that they're going to become rich and not have to go to school anymore. But the reality is it's probably going to put you in school for even longer, because kind of what happens here is, like you were saying, Dave, is like a doctor. Like you spend years and years and hundreds of thousands of dollars studying and getting an education. Trading is no different. It's a profession, and experts aren't born overnight. And people spend years and tons of money on PhDs and stuff like that. It's no different in trading. Is that you have to educate, invest in yourself, and then also spend time. Is you got to spend some tireless nights and really love it to be able to be successful in this industry. It's not as simple as they make it seem on those YouTube ads, and it's not a get rich quick type of thing. And we got to make people understand that.
So what? So you got any good tips for us? What's been talked about recently in your chats? What are guys talking about this market? Are they optimistic that we're moving higher? Are people really cautious? What are some themes that you're noticing lately?
Yeah, so the themes that I'm noticing is so number one, when the whole market crash, right? So when we say the crash, we kind of know what we're talking. We know this similar time period we're referring to is that our moderators were net short. We had short positions on oil, and needless to say, it hit very large. Like we hit big. People were making a lot of money. It was really good. And then, what happens is after that, what we see retail investors is we get a big influx of people, right, saying, oh, I saw you guys making a ton of money. You guys are making, $10,000 on your, Pioneer Resources puts, and that's insane, right? That's awesome, and but that doesn't happen every day, So we get people in and they say, and what people were doing is at the bottom they were buying puts and they were saying, I think it's going to go lower, and retail investors, and what retail is your everyday kind of guy, as he's coming in and he saw the market crash. He saw his buddies making tons of money on puts, and by the time he opened his Robinhood account, he bought a put and the market reversed, and so what we were seeing is retail was being caught net short, seeing a lot of people, like new people, blow accounts because of exposure. The biggest thing, and this is like a volatility thing, is that it was hard to make money up or down after the reversal because the market, the Dow was tanking 12% in one day. So then the options market is pricing in these massive ranges, these massive potential moves for the implied straddle and stuff like that, the straddle. And so even if it's going down a little bit, like the market went down 2 to 3%, which is usually a lot in like a bull market, that's a little, oh man, that was a decent pullback, where puts would pay that day, puts were getting crushed because it wasn't moving 6% on the downside, So what we had to show people, and a big topic and a tip recently was that what is true diversification? How were you able to make money, during the stability that occurred, after the bottom, and where these VIX products were selling off, is how are you making money, And what I am is I'm selling more premium, and I'm selling more premium, specifically like 2 to 3 times implied move outside of the money, very high probability trades, stuff like that. And what true diversification is people think that I have a Tesla call, so I'm going to hedge with a Tesla put, But that's not diversification. That's like a strangle, is because what happens with this when the stock is sideways? What happens when it goes sideways? Your calls and your puts both lose. And what we were seeing in the market was that people had calls and puts, but it wasn't going sideways, but the market was pricing in a range like this, and it was only really going like this. So you were getting crushed on both the call and put side. So how were people actually making money? So true diversification isn't calls and puts, like 60% calls, 40% puts, but it's 60% maybe debit trades, which is buying options, and then 40% selling premium, like credit trades, such as credit spreads, butterflies, iron condors, stuff like that, which is short volatility, if that makes sense. So you need a little balance. That's true diversification, is 60-40, maybe long volatility, short volatility, and then in your long volatility portfolio, then you have to figure out trading directional. 60% of that is calls, 40% of that is puts, or whatever it may be. Does that make sense, Dave?
Yeah, and you're really mirroring what my guest yesterday was talking about. He was talking about how the spreads were so wide and vol was so high that even if you were right on direction for a while, it was hard to make money. And I'm going to get to a couple of questions in the chat right now, but yeah, I just wanted to talk for 1 sec about, just to expand on one thing that you were talking about, which is that it's harder for somebody to sell options in a market than to buy them, because you have to have special permission. Not as many people want to sell options. And for this and other reasons, in general, and I think Tasty Trade goes into this a little bit, but in general, option prices are higher than they should be. So in general, there's a slight edge to being short options compared with buying them. And so it seems that as a retail trader, it can be very hard to own options and successfully making money. You have to be very precise with what you're doing. Let me get to a couple questions in the chat, though. And first of all, to this Farhan, I want to. He signed up for a membership in the middle of this chat 2 days ago when we were having some issues with the chat, and so I never got to acknowledge his membership. So thank you so much for signing up. But I have 2 questions here from people, and maybe you could field these. First is from him. It says, can we talk about some good portfolio distributions within stocks, funds, ETFs, percentage of those for day trade versus buy and hold? Do you want to try to tackle that? I'm not 100% sure what he means.
Yeah, let me try to decode that question a little bit. I mean, the first thing I see is portfolio distribution. So I'm thinking about like diversification and risk management, and specifically what we call this is asset class allocation. And you're saying like funds, ETFs, options, stocks, gold. So you're wanting about different assets and how they correlate with each other, and say you have 100% of what percentage needs to be in commodities, what percentage is in fixed income, what percentage is in your options trading portfolio, what percentage is in domestic equities, what's in international equities. There's a whole different range of asset class. What's in real estate? There's so many different kinds of investments out there. Every single person has their own way of doing it. Kind of what I have more of an endowment perspective on it, like 100 to 150 year type thing. I don't necessarily think you should be like heavy stocks, but I think you have to have a balance at all times of everything. So, for example, like a very general benchmark, which is kind of how I invest my money for the most part, is I take a 1/3, 1/3, 1/3 approach, and 1/3 is stocks, 1/3 is fixed income, and the other 1/3 is alternatives, right? So. Let's break it down here. So 1/3, let's say it's like 30%, right? 30%. And so 30% will be in stocks. And what I'm going to do is I'm going to take a weight between domestic and international stocks. And this is just a long portfolio where I'm just buying stocks to hold them. But I want to have a diversification between the U.S. I want diversification between India. I want emerging markets in there a little bit, But we need to take a look at ETFs versus it's all like a pie chart within a pie chart within a pie chart, if that makes sense. But what I would say is a few ETFs I really like right now is stuff like XLK. I'm a big fan of I actually bought the stock today. It's DLR. It's called Digital Realty Trust, and that would fall under that 30% alternatives. Usually what I mean by alternatives is you have like 30% stocks, 30% alternatives. That's like gold, silver, different kinds of commodities, and also real estate. I think real estate is big that people, it slips a lot of retail investors' mind is how can I invest in real estate with $100? There's things called REITs, or real estate investment trusts. It's REIT. They trade like stocks, and it's with a little bit of money you can get into different kinds of diversified real estate trusts that trade publicly. For example, would be one of those, and then also fixed income is like bonds. Is whether it's like TLT or TLH, or it's a fixed rate with your your regional bank. You got a good 5% over a year, you were able to lock in that rate or something. I'm not sure, but there's a wealth of different ways to do it. But what I do is I do 30, 30, 30, and then 10. And what that 10 is that's my options trading portfolio, where that's my active trading portfolio, if that makes sense. And then we have 30% stock, 30% alternatives, 30% fixed income. Within stock, you have domestic equity, international equity. Within alternatives, you have commodities and real estate. And fixed income is going to be more like bonds and stuff like that. But if you want to go a little bit more in detail on like specific stock picks, I mean, I can talk a little bit about that. But that was more like macro focus. That's more like diversification. That's a portfolio manager. That's what a portfolio manager at a hedge fund is going to be worried about mostly.
Well, the other thing is just that it's really going to depend on your individual financial situation. For example, for me, and this is going to be true for a lot of people, I'm going to inherit money at some point, and my family has positions that are being controlled by someone who's not me. So that's going to come into play. Other people are going to have different situations, and so it's very hard to kind of give a blanket answer, I think, to that question. And let's try this other question real quick here from this other person, Zach. He says, I have a question from something I noticed today I don't get. Why is something like the SPY up so much when the volume was much lower? It seems like low volume would mean less demand. You want to take a stab at that one?
Yeah, I mean, I didn't take a look at volume today. I'm not sure if it was low, but let me take a look at the question. And so like, why is SPY up when the volume is much lower? Low volume would mean less demand. So it's hard to explain always. Why is the market up today? I mean, you'll get investing.com and CNBC who come out with their headline as soon as the market closes, and they always have something that they're blaming the market on. It's today, like I saw this morning. When we started getting that pump, it was Fauci is optimistic on a virus peak. And kind of what people were saying is that once a peak is in, you're going to see more buying in the market. So maybe it didn't translate into volume, but there's some optimism. Then you have, the second headline of the day was Bernie dropping out of the race. You got a big pump out of that, which I'm not looking at volume today. And Dave, maybe you can speak on like if you're looking at volume today. I don't know if it was lower than usual, but
well, I think it doesn't really. I mean, it's just who's in there. It's not necessarily that that volume means buyers. It just happens who's on the bid and who's on the offer right now. If it's thin and there aren't many players out there, then a relatively small amount of buying can move the market. Volume is deceptive, and I know there's a lot of people that come out with videos here saying, well, the basic message people will have on sort of YouTube videos is that like, if it rallies on big volume, then it's a quote-unquote real rally. Or if it sells off on big volume, it's a real sell-off versus smaller volume. But what I noticed in a big crash situation, which was in 2000 to 2001, is that people left the marketplace. Retail was gone. People were gone. And we just saw low volume, basically because people threw up their hands. Remember, most people are long the stock market. Most people buy stocks and they're long the market and got killed, right? So a lot of people have just left. They don't want to play. A lot of the money in the market is just a few rich people's money that's just sitting there, right? The money that's being traded, there's not as many small players around right now because a lot of people are like, I'm done with the stock market thing. I'm gonna work on the Golf Channel or on Netflix. I'm going to watch Netflix for the next couple months or something. And so I wouldn't correlate volume with meaning, demand for stocks moving up or down. If it's thin, it just happens to be thin. And if there's not someone on the offer, it's going to move. It can drift higher. It doesn't mean it's any less real than if it's on high volume, as far as I'm concerned. And I don't have in front of me the numbers today for volume, but yeah, you don't need high volume to drift higher or lower. It just means that stuff's thin, and we know we're going into a, it's only a 4-day week. People aren't around. Some people have left early. Some people are trading from home and have just turned off their computers. Stuff is thin right now. It's not a normal situation, and I wouldn't be surprised. It's not surprising to me at all that there's not that much volume and stuff's moving around like that. And be prepared for that. Even coming into tomorrow, be prepared for there not being very liquid stuff. I mean, we're seeing, somebody actually just contacted me today and said Coca-Cola options, they just listed these new weekly options and there's almost no volume in there. That is going to be a characteristic of this market moving forward, is there's just not a lot going on. So be very careful trading options because they're going to let you in, but they won't let you out a lot of times, I think.
Right. Yeah, that's a great point, Dave. And I appreciate you, clearing it up on the volume a little bit there. I would say that there's many different indicators, and if I'm going to be completely honest with whoever asked that question, is volume is one of the last things that I trust. Because what I relate volume to is I break it down. I'm like, okay, it just means how much is trading in the market. What does that really mean to us? I'm not sure if that has any kind of fundamental implications. That's not telling me how the virus is doing. It's just telling me, hey, how many people had cash today to buy into the market? It doesn't tell me necessarily about the health of the economy, which is what we really should be looking at with the market. I'm looking at different things like momentum indicators. One of them that I really like is, we teach you all about technical analysis at Eagle Investors, but we have stochastics, which that's a momentum indicator, which I really like. I like it more than RSI actually, because just because something's oversold doesn't mean that people are going to buy it. And just because something's overbought doesn't mean it's going to go down, because people can still keep buying it. I really like different kinds of momentum indicators when you can see the shift of the sell volume versus the buy volume. That's what really matters in my mind is, what's the split and where's the momentum really? Is it buyers or sellers? Not necessarily like the pure all of them together.
Yeah, so we've seen the VIX really come off in the last few sessions here. VIX is down three points and change today, and we're less than a point off of the front month future here. So we're getting pretty close to coming out of backwardation here in the VIX, and it's starting to look more and more like we've seen a bottom in the markets, and that things are kind of settling down here. What's your sense just in general terms right now? And let me just say for a second that every trader is going to have different opinions on stuff. And if you ask 10 traders what their sense of things is, you might get 10 different opinions. And that doesn't mean one of us is right or wrong. It's just that's a characteristic of traders, is that we're going to disagree with each other. It's just the way it is. But yeah, what do you see with this market, and can you make any sort of predictions in a kind of a macro level about the economy and the markets in the next couple months?
Yeah, that's a great question, Dave. So what I would say is, let me take it slow here. So fast forward, or sorry, backtracking a little bit. We remember, before the sell-off, we had like a little lump. We had a small sell-off, like a little glitch. Before the big dump. I'm not sure if you guys remember that, but I saw a lot of people, buying that dip, saying, "Oh, it's just going to keep on the rocket ship going up." Coronavirus really showed us that if there's such thing as a black swan, that was it. It's shutting down the entire country. I've been doing a lot of investigative work personally. Speaking with people in my family about like independent doctors, people who own their own practices. Who make the majority of their revenue from checkups, and from daily stuff. And now it's only essential business. It's only emergency procedures and surgery and stuff like that. These people are struggling. These people are struggling a lot. They pretty much they're in survival mode for their corporation right now. But I do see the stimulus that the government is offering. People will say, what we get in the chat is a lot is that this is a fake market. It's rigged. It's propped up, and there's no reason it should be going up. But I did more investigative work into what the stimulus is. And what the stimulus is they're giving grants and loans to the people who need them, and to be able to hire back the employees to get over this short-term lump. So I'm not sure if you've heard about what, you can look at the media and you can hear what Trump is saying, and what, Mnuchin, the Secretary of the Treasury is saying. And they're saying this is going to be the fastest recovery in the history of the economy. I can't speak for them, but I do know those guys at the Fed are and the guys at the Treasury do know a little bit about what they're talking about, and they do have the money machine. And Dave was talking about the market is a lot of a few rich guys who just park their money in the market, and that's what it is, And I wouldn't say it's necessarily rigged to go up, but at the end of the day, as an investor, we hope that and what we bet on, and why we go to sleep comfortable at night with a lot of our money in the market is that one day the market will be higher than where it is currently today. And that's the thesis that we take. And that's because we think that the technology and innovation, and break it down to the philosophical level, is that humans will continue to evolve, and reproduce, and technology will increase and innovate, and that, the computers they are today will be less advanced as they will be a year, 5 years, or 10 years, or 40 years from now. So I'm not necessarily telling people to buy stocks, but I saw this as an opportunity to average in. Again, I wasn't buying the falling knife, and what we say is a falling knife is when it's falling very hard, like when the Dow's going down 12%. You have Warren Buffett going on CNBC saying, I'm buying this dip, but it doesn't mean he's buying the dip now. And what we say is, the saying is don't catch a falling knife, because if a knife falls off a table, you catch it, you're going to cut your hand, you're going to bleed. What we do is we wait for the knife to hit and fall hit the ground, so we can pick it up and we're not cut by the knife. So I did wait for it to hit the ground a little bit. We do a lot of technical analysis. What I did do is I averaged in around the 2018 lows. I never thought we'd saw a SPY under 250. I did buy some stocks there. I did buy a little bit more today. I bought some Salesforce, which I was looking at, and then some of that DLR, which is Digital Realty Trust. Salesforce is CRM. If anybody's just looking into, at the end of the day, I don't know when I'm going to be right or how I'm going to be right. We do have some analysts looking into that who thought they were going to be pretty good. But Overall, I'm more than prepared for the market to fall down to the 2016 lows during that that double bottom support of 2015 to 2016. If you do look at like the SPY and the markets, it's a possibility. Very well, OPEC could go very poorly, and it could go down to a brand new low for oil, which obviously is no good for the consumer. The coronavirus could have a wave two, which is very possible, wave two or wave three, which is a potential possibility. So people think that we can have a very swift recovery, but anything can happen. But what I've created is an entry strategy. It's an entry strategy. My entry strategy was that I'm comfortable buying in at the 2018 lows, and I'm comfortable buying in at the 2016 to 2015 lows. I don't really care if we get there or not. I'm just looking at if we get there or not. And if we get there, I'm going to pull the trigger and stick with my plan. If not, I'm going to be happy because I bought at the 2018 lows, So it's all about developing that plan and sticking with the plan. And we shouldn't be going every single day and saying, oh, like, yeah, I think I'm just going to buy today because the chart just all of a sudden looked good today and it didn't look good yesterday, is we gotta develop a plan on the downtrend is when are we going to be buying. So, at Eagle Investors is we're always stressing that, and we're communicating to you guys what our top investors' plans are, with our charts and our logic is where are we actually buying stocks right now and stuff like that. But Dave, that was a long answer. I hope that made sense.
No, that makes total sense. I always think of the market as, every Friday, people's paychecks, and granted there's less paychecks right now, but every Friday, even more so in recent years, people are putting money in the market. Every year there's more people in the world. There's only the same number of stocks. The population's growing. There's less places to put money. And you have to overcome all of these forces pushing the market up to make it go down for one day. And so it's... it tends to go higher, and I could see people get caught when we had this big rush down. We had several days where it would go up, and then it would go straight back down again. And I could see the light bulb in retail investors' heads going, hey, next time it goes up, I'm going to sell it, and it's going to go lower. And as soon as we got to that point, you could tell it was going to reverse, and a lot of retail got short, and it went back up. So, if you can do a little bit, I have a friend online who's really good at doing this, like psychology, like what is the average person thinking, and do the opposite type thing. And
right.
You can use some of this psychology to your advantage. But in general, it's boring to say I'm going to be long the market and it's going to rally slowly. But that's what it does most of the time. And somebody who comes on YouTube and says the market's going to crash, it's going to be a zombie apocalypse and blah, 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 is going to get 10 times more views than we are. But they're not going to be right, 99% of the time, because most of the time the markets do rally. So there's stocks at a discount right now. Now, I wouldn't chase stuff around, but when you get a nice down day, it's not a bad idea to just buy a little bit. Chasing stuff around is going to get you hurt because we've seen stocks move all over the place. One of the ones that I've been watching is DRI, Darden Restaurants, and it's gone from 26 to 65, back to 45, back to 65, and you can chase stuff around. So it's buy stuff on a discount and sell stuff when it's higher. And I know that's a simple thing and it's easier said than done. But anyways, we're kind of running out of time right now. I appreciate, and I know your time is valuable. And I'm going to put in the comment section information for how people can find Eagle Investors.
Okay, wonderful. Well, thank you so much, Dave. And just the last thing I would add on is that buying the dip never failed in the history of the U.S. financial system so far. So unless that's going to change, I'm going to be buying some dips. That's a general saying is that if you think about it, you look at every single recession is that the market did recover to a higher level than it did before the crash. So unless for some reason since the inception of the U.S. stock. Yeah.
I think I lost a lot. I think I lost
Sorry,
the last
Davey.
20 seconds because I think Skype kind of died on us for a second there.
Oh. Yeah, no problem. But what I said is buying the dip never fails. Crashes. You look at 87, you look at the dot-com bubble, you look at 2008. the market always recovered to higher levels than it was previous to that recession or crash or whatever it may be. So unless that's going to change for the past 100, 150 years since the inception of the U.S. stock market, we can be confident as investors. And
do you want to take a you want to take a stab at the last question there in the chat?
Yeah, so I see Jeremy, one of our members, long in the shorts. He asks, is the Fed money really stimulus or just to keep business alive? If not, will it run out of bullets? When is it time to do actual stimulus? So that's a great question. I would say that the stimulus is there. There's many different kinds of stimulus right now. So number one, what you have is you have like Congress stimulus, right, which is the $2 trillion stimulus plan, which we're seeing. And what that is they are creating it's initially a loan. So what you're doing is you're applying for, say you have a business that's responsible for like 500 employees, and you just had to furlough or furlough 150 of them, and what the government's going to do is you're going to apply for a loan, and they're going to give you a $2 million loan, and you're going to take that $2 million and you're going to hire back your employees so that you can flush liquidity into the system. That's what they want you to do with the money, because they want you to pay your employees who can then spend that money back into the economy. If that makes sense. So what they're hoping to do is kind of put Band-Aid on a bullet wound with small businesses and stuff like that. And what they're doing is a loan, but if you do it properly and you pay, you hire back 65% of your employees by June with that money, then it turns into a grant, and a federal grant, so you can hold on to it. So that's kind of what that's what the congressional stimulus is, and the $2 trillion. Then you have the Fed, and what the Fed's doing is they're they cut interest rates to 0%. They made like unlimited overnight lending for the banks. So what they can pretty much do is take money fresh off the printing press and dump it in the stock market overnight. So I mean there's different kinds of stimulus, and people think the economy is just the stock market, but that's not true. The economy is your salary and your business and your small business, and that's what Congress is doing. And we think a lot of the time like, oh, those politicians out in DC, but I did a lot of reading into like how this is actually helping your everyday guy with that $2 trillion plan, and hopefully they can get some more of that stimulus. But that's really what's going to be helping. Is it's flushing that liquidity back to the everyday person who lost their job. And you give them the money to spend it back in the economy. So that's what stimulus really is, and it's Band-Aid on a bullet wound indeed. But sometimes it can be enough of a Band-Aid that the bullet wound is, forced out itself, or, they cured it and they put the Band-Aid back on and it heals, So those guys are smart, and they're not doing it for no reason, I can tell you that.
Yeah, and plus, I mean, if you think about it, $1,200 times everybody in the population, that's a lot of money that's going to be flowing into the economy. And we talk about a multiplier effect if you study economics. I mean, a lot of money is going to be coming in. And also, a lot of people, they don't talk about it so much, but a lot of people are getting $600 extra bucks per week on their unemployment. And that's going to be a ton of money flowing into the system here. So I think that's going to have a really real effect. Anyways, we're out of time, unfortunately, but I really want to thank you for coming on the show, first of all, but even more importantly, thanks for all the viewers for checking it out. Please check out Eagle Investors. Like I said, I was really impressed to come on there and see people that are taking this really seriously, and that excitement and that energy to learn about this stuff. I think you have a unique environment there, and I would recommend, I think it's a good investment for people to jump in and check that stuff out. So everybody, thanks for watching today. We're going to have some more special guests coming on next week. Best of luck. Remember that we do have Friday off this week, so tomorrow's the last day. Be aware of the fact that there's not that much liquidity out there, and we'll see you next time on the show. Thanks again for watching, and thanks for coming on.
Yeah, thank you so much, Dave. It was a pleasure, and I'll see you soon. All right?
All right, sounds good.
All right, man. Take care. Bye.